Hi everyone, welcome to another financial analysis video with myself, Moe Damin, and my colleague, Ted Wainman. So today we're going to be looking at a company involved in sustainability, Greencoat UK Wind. But before we go into that, very quick note, this show is all about raising the financial literacy of all of our viewers. So whether you are involved whether you're a sales professional, whether you're interested in investing, or whether in your career to move up that career ladder, your financial knowledge has to become a lot better, this is the show for you, right? So pay note and attention to what we share here, because we're not going to be looking at the quarterly statements. We're looking at the annual statements. But from what you learn from us, you're going to be able to read those quarterly statements really well, and you're going to get a very good story and picture about the company that you're interested in just by looking at the financial statement and being able to analyze that. So let's go on to Greencoat UK Wind. So just a little bit about the company. So essentially they're involved and they invest in UK wind farms. So they're exclusive to the UK industry right now from what we've read about them. You can see some information about their targets and returns to investors, but they're very much a part of the UK's sustainability play. So in COP26 summit, the UK made a legal duty to become net zero in terms of greenhouse emissions by 2050. So Greencoat are very much a part of that story. So stick around, we're going to go into the finances around the company and also about the shares. Before we go into the shares, this company was a request from one of our viewers. So about 98% of the companies that we analyze come from you, the viewers. So leave a note in the comment section and let us know about a company you're interested in as well, and leave some context behind that, some description. So a couple of people, Gary Smith and the other person, XDC, etc. They made a request. Here are your videos. So we're going to go into the share price in a moment, just some context behind that. So if you'd invested when they first floated in 2013, you'd be sitting on an increase of around 56%. 5 years ago, you'd be up 27%. And from 1 year ago, you'd be up 18%. So this company is growing in terms of its share price. We're going to be looking at the finances moment. And at the end of the video, we're also going to look at that share price just so you get some context behind that. So without further ado, Ted, please share with our viewers what we have found about the finances on this company.
Yeah, good to see you, Moe. Thank you very much indeed. So yes, welcome to everybody. I hope you are all very well. Greencoat UK Wind. Here we go. So here is their accounts. Now, put a caveat on this one, Moe. This is a slightly different company to the kind of the normal companies that we look at, and I'm going to show you how you could, or how it jumps out at us. This is an investment company and therefore is effectively like an investment trust. Okay, so let's look at the accounts now. Usually what happens is that I scroll down through all the kind of the annual report very, very quickly in order to get into the kind of the key numbers, which we've done just now. What I am going to do is we're going to go back and look at some parts of the actual annual report, some of the information contained in that. So in effect, so these guys are investing in wind farms, okay? And in fact, I'm going to go back and show you this because I think it's important that we understand what we're looking at. So when we look through the accounts and there's a kind of, who's doing it, and there's our investment manager. So well done to those two guys. But here's the investment portfolio, okay? So these guys own wind farms, and if we take an example at the top, they own Andershore Wind Farm, and wind farm has Vestas turbines, is operated by Statkraft. The PPA, I don't know what PPA means, is also Statkraft. It gives out megawatts, and they own 100% of it. So effectively that makes Andershore a private company. Now this is a very important concept. Bickerfen, they own 80%. So I'm guessing that EDF, who's the operator, owns the other 20%. So you'll see lots of these companies, they own 100%. If they own 100%, they're not listed. They are owned by this company here, and this company is of course listed. Now this is important because what we're going to see is when we look at the accounts, what we're not going to see is, for example, the cash of Bishop's Thought, the cash of Bin Mountain, the cash of Bickerfen, the cash of Andershaw, all amalgamated together. No, what we're going to see is these guys, an investment, and then them receiving the kind of the income from that investment. So if you want to see, for example, and I was doing this just earlier because that's the kind of person I am, Moeed, Earl's Hall Farm, you'll see down the bottom, you can go onto Company's House and you can look up Earl's Hall Farm wind company. You can look it up on Company's House. You can find their annual reports. You can do the analysis. You know, we've been doing it with lots of different companies, so hopefully you're getting a little bit better. And there's an online workshop, which I'll plug as well, which will help you analyze financials. So you can analyze their accounts, but it's a private company. There's no third party share price for it. Now, this is important because these guys are investment trusts. So this is a really good way of, if you want to invest in wind farms, and the wind farms themselves are private companies, that makes them very illiquid, very difficult to sell out. So this is an investment trust. It's closed-ended, which means that there's a limited number of shares, and if you don't want to be invested in them anymore, you can just sell your shares like that tomorrow, which makes it a very liquid vehicle for investing in illiquid investments. Now, this is important. Some of you may have heard of an investor called Neil Woodford. If you haven't heard of him, look him up on Google. It'll tell you all about him. Neil Woodford ran a fund, but it was an open-ended fund, and he was investing in illiquid investments, not wind farms, but other types of companies. And when his investors phoned him up and said, I want my money back, he said, I can't give you the money back because they're invested in companies, and I can't sell the companies because they're illiquid. So if you are going to invest in illiquid underlying assets, such as wind farms, do not invest through an open-ended investment company. You want to go through a closed-end invested company, like a unit trust, sorry, like an investment trust, which is like these guys. Okay, so Greencoat is a good vehicle for this. Now, I'm not saying that it's the right vehicle for it, but the structure is right. So let's look at the actual numbers that are coming through. Here's the return on investment. So, you know, the return, they're getting a return of 423. We're in thousands of pounds. You'll notice it's about 423 million pounds. They've got the costs of running. This is the cost of running their investment management team, 26 million, which, you know, seems quite a lot. I'm sure that there's you know, the fund managers are taking a you know, fair old chunk of that, but that leaves them with an operating profit, and you can see, you know, quite a nice little operating profit, and earnings per share 18p, up from £6.55. So some of that's going to be paid out as a dividend, and some of it will be reinvested. Okay, so looking, you know, so we can see the return on investment, some pretty significant returns coming up here, some nice big returns, and a lot of that will be driven by things like, you know, government subsidies into kind of wind farm energy, etc., etc., etc. So if you think that that's a good play, then this could well be the vehicle for you. Okay, now it's not telling us any more than that. It's just saying that they're making a big return, and there's a, you know, a reasonable cost to generating that return. So it doesn't come for free. For example, you know, the cost of the investment managers and any infrastructure they've got around them, what's known as the total expense ratio in the business. Consolidated financial statement. So, you know, here's their balance sheet. So really, the balance sheet is the investments. Okay, now you'll notice that the investments are at fair value. Okay, so what they're trying to do is to kind of assess what those investments are worth, but that's a guess because we don't know what they're worth because they're not listed, they're private companies. Okay, but that is basically the value of all that list of wind farms that I was showing you earlier. They've got a little bit of current assets and a little bit of current liabilities, but those are, you know, basically immaterial. And then what you'll also notice down here is a big leverage play. Okay, so about a quarter of this investment is funded through debt, and the other 3/4 is invested through equity. So this company, they take your money, they take some borrowings, they put it together, they make the investment, and you know, through this concept of leverage, it's a bit like house prices. You know, if you buy a house on debt and the house price goes up in value, you make a lot of money, you make a big return. Problem is, if it goes down in value, you lose a lot of money. So you want to be quite careful of leverage, and 1/4 does not appear unreasonable. It's something that investment trusts are able to do. So it's another benefit of these investment trusts, is that first of all, they provide you with a liquid way of getting in or out of underlying illiquid assets. So commercial property, you know, again, very good way of you know, investing in commercial property rather than through an open-ended investment, investment companies, which you may remember actually had to close. They had to just shut down to investors back in the financial crisis and in the pandemic, because people wanted to get their money out, and the only way to give them the money back would have been to sell the underlying properties. So a little bit of debt sitting there, and then the rest is equity. We can see the equity in here. We notice that the share premium account. So you know, these guys, you know, they're investing in more wind farms, and you know, basically what they're doing is you know, raising money to continue that investment. So you know, they're going back to the shareholders. They're saying, give us more money. The shareholders are saying, yep, here you go, here's some more money for you, and then they are investing it in more of those kind of those assets. There we can see the dividends that are being paid out. So these are the dividends, 138. So you know, reasonable you know, reasonable return, which is pretty good. So pretty consistent dividend payers, and that's part of their, you know, that's part of their attraction and part of the deal, I guess. Net cash flows from operating activity, so they got positive cash flow. There's the acquisition, so that's kind of basically buying wind farms, for want of a better phrase. And then how are they funding it? Well, they're issuing more shares, and there is a little bit of you know, kind of you know, here's the debt. So you'll notice that they actually repaid. So the debt refinancing, but they kind of repaid more than they borrowed. And in the previous year, they actually ended up raising more than they repaid. And there's the dividends that they're paying out. Okay, so you know, it's a dividend payer. It's a leverage play. They're raising money. They're continuing to raise money to invest in more wind farms. You know, either as a part investor or as the sole shareholder. They'll be using some of their kind of experience. So they'll probably, you know, they'll have a team who are able to kind of troubleshoot for wind farms, to kind of, you know, improve the operation and share knowledge rather than competing against each other. They're collaborating, and there'll be benefits sitting within that. So there's the account. So very important that we look at this in a slightly different way. And if we think about this kind of this balance sheet back here, so this balance sheet here's the group's balance sheet. So if you buy this company, you're buying the net assets of just over £3 billion. So that's this kind of this equity, this bottom line. Let me just highlight it. So you're basically buying, and that's what's known in the kind of the trade as the NAV, or the net asset value. So that's the assets net of the liabilities. And when we look at investment trusts, we talk about whether the company is trading at a premium or a discount to the NAV. So very rarely does an investment trust trade at exactly the same price as the underlying assets. What you find is that sometimes it's trading a little bit higher at a premium or a little bit lower, and that premium is what we've been calling goodwill for other companies, but we don't call it goodwill in the investment trust world. So when we look at the share price of these guys, and we'll do that now, we'll pick it up. So the share price, we can see the market cap is 3.7 billion. So 3.7 billion says that they are trading at a premium. Now, there's a couple of reasons they may be that they're trading at this premium. One of it may be that we just think, wow, this is a really good investment, really good opportunity. It's a buy. The other option may be that actually the underlying assets aren't fully valued. So maybe they're undervalued in the accounts, and therefore actually the real value of those assets is understated. Okay, we talk about fair value, but the accountants have got to come up with a reasonable assessment. If the company is not traded in the market, you don't know what it's worth. You only know what it's worth when you actually go to the market and say, buy my company. Okay, so they're illisted companies, sorry, illiquid companies, unlisted, and therefore very difficult to value. So when we look at this this market cap, it's a small premium. It's about a 20% premium. It looks typically pretty high, but then they are unlisted companies. The PE ratio of 8.7, so it's about 9 times earnings, looks pretty good to me. I'd definitely take a price to earnings ratio, and even the dividend yield that it's down here at 5%. They talk about kind of a target of 6%. Any way you look at that, that's got to be a pretty reasonable, a pretty desirable and pretty reasonable yield. What happens in the future, we can see, looking at the share price. So that's pandemic related. So basically kind of just chugging along and a one-way bet. Pandemic related, bounces back, and then kind of we just see a bit of a decline going on. And I can't remember the exact meeting of COP whatever it was 26 in Glasgow, but you kind of get the impression, especially from the comments we've had, that this is all about, oh gosh, the UK, they've got to go energy efficient. They've got to invest in wind farms. These guys are good at it. This is the place to be. So I'm thinking that this looks, I mean, it looks quite toppy. But then on the other hand, it looks, kind of the trading range. I'm not necessarily saying it's going to go all the way up here. But it may kind of, you could, I don't know, you could do a sort of something that looks a bit like that, for example. But it looks to me like it's a reasonable business. It doesn't look expensive. I'm not saying it's necessarily cheap, and I think that this is definitely not a, you're not going to get rich overnight, but this is, I would put this as a long-term play. This looks like a long-term play. It doesn't look overpriced. A long-term play on the kind of this move to energy, what have we got, carbon neutral by 2050 or whatever it is, blah 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 blah. And I guess but it is dependent on the government's energy strategy. So if the government then says, actually, you know what, we're going nuclear, suddenly these guys could find that actually they're less relevant than they were. So you're definitely making a political play on this company. So there you go. That's my kind of tuppence worth on Greencoat. I'm not sure we really provided a huge amount of kind of insight from the accounts, because it's really just it's a company that just collects the the dividends in from the wind farms that it's operating. It's collecting in over 400 million quid, and it cost it 26 million quid, which means a few of the directors are doing very nicely. Thank you very much. And that's your business. And if you want to be in wind farms, I'm sure there are other investment vehicles out there, but this is a pretty well-known one. It's pretty high profile. I've had a few people ask about it, and I think that it looks a not unreasonable part of your long-term portfolio, Moe. Let's put it like that.
Yeah, so sounds fair. And we've helped our viewers read and understand the financial statements of investment trusts, which is great. That's the whole purpose of this show. So love to hear thoughts from anyone who are experts in this area. And if you leave some comments, please do so, and be polite about it. Of course, we all like to learn. This is a community. So again, like, share, subscribe, particularly subscribe, especially if you're someone that's made a request for a video. If you're a subscriber, you will get a notification the moment that video has been published. So until the next video, thank you, Ted. Thank you, everyone. We'll see you on the next video.
Good to see you, Moe. Catch you later.